now we move on to our final panel today, which is focused on the specialty of subcontractors. This is an emerging and quickly growing PE-focused industry, and we are very excited about this panel discussion. To introduce our last panel, I would like to welcome Jason Brown to the podium. Jason is the founder and managing partner of the PGP Advisory, a mergers and acquisition advisory firm based in San Antonio, Texas. He's a seasoned business leader, M&A transaction professional, and entrepreneur with over 20 years of professional experience that he uses to help his current and future entrepreneurs successfully navigate the business sale process. He works closely with the middle market clients to establish value of their business, identify an exit strategy, and successfully close the sale of those transactions. Jason held leadership positions in both business operations and mergers and acquisitions, with roles in several Fortune 500 companies across various industries. He's helped small business owners implement growth strategies, execute profit improvement initiatives, and develop their leadership and organizational capabilities. Jason leverages his knowledge and experience across both the corporate and entrepreneurial worlds to create value for his clients. He is passionate about doing good deals for good people. Jason earned his MBA from the University of Michigan Ross School of Business with a concentration in entrepreneurial finance and general management. His BS is from Northwestern University in mechanical engineering. Jason was appointed by the Secretary of Commerce to the Texas Camino Real District Export Council and is the group's executive director. He also serves on the Velocity TX Community House Strategy Advisory Committee. Welcome, Jason.
Good afternoon, everyone.
Get you to introduce the panelists.
Yes, absolutely. So today, if you could join me, Brandon Upp, who is the Vice President at Main Street Capital Corporation, and Jason Hartman, who is the Principal at PGIM Private Capital. Welcome, gentlemen. So I believe we are the last thing standing behind the group at happy hour. Never the best place to be. But I'm really excited to be here with both of you gentlemen today and to be moderating this panel. So in doing some research, I saw that there are 469,000 specialty subcontractors across the U.S. that make up about $850 billion in total revenue across the U.S., which led me to think about, okay, there's a lot of room for deals and activities to go on in space. I'm very excited to have two individuals who can speak both from the lending perspective as well as from the investor private equity perspective today. But with that, I'd like to turn it over to Jason. Introduce yourself, and then Brady, you can introduce yourself afterwards.
Yeah. Thanks, everybody. Jason Hartman with PGIM Private Capital. Some of you may know us as Prudential Private Capital. We're a credit-focused shop, part of Prudential, the insurance company. We've got regional offices, 8 regional offices around the U.S. I sit in Dallas and other parts of Texas, Louisiana, and Kansas. But we've got regional offices around the country and then 7 more globally as well. A wide range of capital options, everything from what I'll call kind of the traditional insurance company private placement, long-term fixed rate senior debt for generally larger companies. And then in terms of the middle market and lower middle market, we have a direct lending strategy, senior secured floating rate, and also a mezzanine strategy. Those are both deployed a lot in PE buyouts, but also we do a lot of non-sponsored work as well in both of those forms of capital. So oftentimes an intermediate step to a more of a full sponsor exit.
Great, thanks, Jason. Hi, everyone. Brandon Upp at Main Street Capital. Main Street is a publicly traded investment fund. We have around $8 billion of assets under management. I'll say half of our portfolio is on what we call the lower middle market space. It's private equity businesses between 3 and 20 million of EBITDA. We're typically one stop in the capital structure of those transactions, so we're both the lender and the equity sponsor in those deals. In that strategy, we have around 80 portfolio companies across the U.S. They range from a wide variety of industries, everything from manufacturing and industrial assets, to business services, so on and so forth. Really, what we envision, and see as kind of the backbone of, the American economy. Things that we don't touch: real estate, oil and gas. Despite being in Houston, we don't do a lot of oil and gas fields. Generally, if we're looking at one of those assets, we know that we're not the smartest guys in the room or in the space, and there's usually a reason that we're the ones looking at it. The other half of our balance sheet is more of a credit-only focus. It's working on kind of large club syndicated deals with, household name private equity funds.
So Brandon, let's start with you, and I know you do have some portfolio companies that operate in the subcontractor space. Can you talk a little bit about what those portfolio companies are, and also how did you choose what subsegments to get involved in?
Sure. In the subcontracting space, we have several assets. A couple of them that are Texas-based. One's name is Chamberlain Roofing. They're here in San Antonio and Austin, Houston as well. Mostly, commercial roofing. We have another company called Cody Pools, which I believe is the largest privately held pool company, at least in the Sun Belt, but maybe also in the U.S. today. And then one last that's in West Texas as a mechanical HVAC contractor in the commercial space. Chamberlain's been in the portfolio for a long period of time. It's been a very good investment for us. Cody was an investment that we did, I think, right before COVID started in 2020. I would say there's some pretty big concerns on our part that we had invested a large sum of capital into a residential pool builder, and that was going to be a zero very quickly. And come to find out that everyone decided to build a pool over the next 24 months ended up being a fantastic investment. We've done a lot of M&A with that one. They also do commercial pools for hotels and whatnot. It's been a really good investment for us. And the last one we'll probably talk about the most today is our mechanical HVAC business in West Texas. They're unique in the sense that HVAC firms, they've been the hot topic in private equity for the last 24 months. If you read any Wall Street Journal article, or there's about 1 month of every MBA grad coming out of Wharton or HBS has decided that all of a sudden they're an HVAC expert, and there's a lot of deals going on in that space. There's a lot of roll-up strategies. There's very large platforms in the space with Overs and Pueblo. There's a lot of consolidation in that space. It's been very interesting. We invested in our HVAC business back in 2022, so we've kind of been right in the middle of this cycle, and it's going to be very interesting to see how this plays out over the next 5 years. But that's the detail on our subcontracting assets.
Got it. And Jason, where do you guys lend in the space? What's attractive to you from the various options you have in the subcontract space?
Yeah, so we're generalists as well, and so we're following where our sponsor relationships are going in many cases. In I think of the broader specialty subcontracting space, we've looked at deals, exterior painting. We've looked at disaster recovery businesses, but certainly the largest from a volume perspective over the course of the last 24 months has been in this mechanical HVAC plumbing space. And for us, we found a couple of those deals pretty attractive. I think a couple of things that we like about them, they tend to be pretty strong cash flow businesses. They tend to tolerate a certain degree of leverage pretty well. It's still, despite all this activity, a very fragmented market. So we still see opportunity in the space for folks to grow via M&A. And I think that the ones that we've worked with thus far have had good success in that regard. And for many of them, some of them will get involved in larger jobs, but for many of them, they tend to be a little bit smaller project size, a little bit shorter term projects, which over a long period of time with what I'll call more general contractors, we and many others in the credit space have had struggles with maybe more general contractors that are very long-term fixed price projects. There are ways for those to get sideways, and so I think what we've liked about this kind of specialty contractor space is some of them will go longer, much of them are a little bit shorter projects. The last place that I'll say is we've done some kind of in the infrastructure supporting telecom build-out space as well, and so what we've liked there, I think, is required degree of expertise and some secular tailwinds in terms of telecom, but then also just a good degree of revenue and backlog visibility.
super helpful. And I think you both hit on it. We'd love to get your perspectives on subcontract is broad, and there are different places to play. Jason just mentioned project-based work. We know Tom mentioned in the previous panel residential versus commercial and trying to diversify across segments. And there's always also the services play. Can you, Brandon, start with you, talk a little bit about what your HVAC portfolio company, where it plays, and where you see the opportunities moving forward in the market?
Sure. In the distinction between residential and commercial is a massive distinction in the space. You know, the residential side is, you know, heavily recurring, very small checks. You know, there's reasons that business trades, you know, at 10, 12 plus times. You know, most of the mechanical, more commercial, you know, players are much lower multiples, which if you talk to any HVAC or construction operator, they're confused by it. You know, they view the commercial aspect as such a more technical, you know, expertise, that why is my business worth less than, you know, these residential assets? They view it almost like golf versus frisbee golf in a way. And, you know, it is a bit of a challenge for them, but it's that recurring nature of that service work is you know, hypercritical for underwriting and leverage in any of these deals, and we all know that leverage is a function of valuation at the end of the day. You know, with that being said, there's still plenty of service work within the commercial space. You know, there are firms that, you know, have really, you know, been able to carve out very nice, you know, commercial recurring contracts with, you know, large warehouses or retailers or different aspects where you do have that recurring aspect, and you will see those trade at, you know, much higher multiples and have much more interest from strategic buyers. But that service element is something that, you know, you keep coming back to, and it's something that we evaluate on, you know, M&A activity where we're deploying capital, you know, what our, you know, strategic vision for the asset is over the next 3 to 5 years.
And where, so your current portfolio company out in West Texas, can you give us a sense as to their mix, their?
Sure. You know, today I would say that they're probably 90-10. You know, the service contracts are very challenging to win. Once you win them, you know, you have, you know, a decent amount of, you know, stickiness with that customer, and they're great to win, but they're very difficult to develop, and you sometimes just have to be at the right place at the right time with someone not doing the best job and you being able to slot in. But I would say for our asset in West Texas, it's a bit unique. It's based in Abilene. I don't know if any of y'all have ever been there. It happens to be my hometown where I'm from, and our company there is a bit unique in the sense that it's not the Austin, Houston, Dallas's, San Antonio's, where there's 5, 6 major mechanical players. They're the only shop in town. So they've had a nice geographic moat. But for some of that service work, there are smaller players that can focus on that, you know, it becomes a question mark of, you know, can we greenfield this ourselves? Can we take that business, or, you know, do we ultimately acquire that from someone else?
How about you, Jason, as you look at the space and you're looking at risk and credit risk, how do you evaluate things like the recurring revenue streams and what segments they play in from a credit perspective?
Yeah, so a couple of our clients are in the commercial space. I mean, I think there are some scaled players in that space, and that's where a lot of this sponsor-backed deal flow has been. We tend to focus on the mix of, you know, how levered are you to new build, new construction versus kind of rehab, replacement work versus service work. I think some of the ones that we've done business with have been maybe somewhere plus or minus 50% exposed to kind of new build, new construction, have had a decent chunk of refurbishment, replacement work, and a decent chunk of service work. And I think, you know, understanding that mix is critical to us. I mean, you know, I don't know what there would be a hard cap on new construction, but it's probably not a whole lot more than 50%. I mean, I think that you know, obviously there's a degree of cyclicality there, and on the service side, I mean, there's a recurring nature. There's also tends to be pretty high margin as well, and so that again can support you know, some degree of leverage.
Curious to get your perspective on, and for both of you, on how did we get here? If we look at the trades, let's go back maybe 15 years, likely not the prime area where you have sophisticated private equity funds looking to you know, come up with platform and roll-up strategies. How did we get to this point where we are today, where this is such a hot market?
Sure. I mean, it has the same fundamental core aspect of why private equity exists. I mean, there's aging owners and assets that, need to find a home eventually. Just so happens that this type of business exists in every city across America. It's a highly fragmented space. It really, I think the synergistic play that is, really, adding, gasoline, to this, home strategy has been in the sense that it's really a hub and spoke model. You can have engineers, you can have design elements that are all working with the EPC firms, the architectural firms, that have different pockets of capital and labor, across, different regions. And so adding and tucking in those different, M&A targets is, I would say, probably easier than other aspects. And at the end of the day, having that labor pool, labor is, top of mind and a very important discussion and challenge for lots of businesses, construction, very much so.
Yeah, what I would certainly reiterate the fragmented nature of the market, that just creates a lot of opportunities. But I do think we have seen real value in scale, and I think that's come, both in terms of purchasing power, but I think also just from a multiple expansion, from an ability to absorb leverage. When you think about some of the risks associated with these businesses, some of it may be, the level of exposure to any given one contract, the level of customer concentration, the level of exposure to a certain region of the country. And so I think many of the players that have pursued these roll-up models, they've been to by acquisition, add additional geographies, reduce the amount that the business is exposed to any one project, any one customer, and ultimately that allows them to get more attractive financing, to achieve higher multiples over time as well. But that dovetails with, I think, also just the command of the labor pool, and some of the buying power, which is helpful as well.
What advice, so if I'm a HVAC subcontractor, recognizing where the market's going, recognizing there's a lot of opportunity, what type of advice would you have for that person to pursue strategy-wise to help reduce the risks in their business, make it more attractive to a potential acquirer?
Sure, it's a lot of the things that, have been discussed today. It's the simple blocking and tackling, being ready for that sale process, having the succession planning, done, buttoning up the accounting and finance functions, making sure that, you've done the easy pieces, so that you're, an attractive, target. That's first and foremost. Receiving the best value in a transaction. It's some of those other things. It would be, talking to someone that, has gone through a transaction. There's so many of these that surely, a competitor or two that, you've interacted with, can give you some insight into, what that process looks like. We're talking to bankers of just, hey, what should I do over the next 2 or 3 years that can really, add value, building out a service part, having good data on, your parts and service segment, these different KPIs and metrics that any, institutional investor is going to be really honing in on, and, same on the leverage side, having that, readily available for multiple years, not just the last 6 months, leading into this transaction, to having those trends over time, is ultimately going to get you the best and, highest value, upon exit.
Yeah, they should read Matt's book, first of all. But I think, and part of that is, the preparation here is critical. And I think, from a lender perspective, again, I touched on it earlier, part of where we see the risk in this business is you have these fixed price contracts, there's percentage of completion accounting, there's ways for that to go sideways very quickly from an accounting perspective. And so certainly the way that we look at these businesses, and I would think this is very consistent with other lenders, we're going to hone in on as long of a track record as we can get of project level profitability. And so what I would say to those contractors and folks in the audience that might be advising them is make sure you have good data around that, around your history of projects, how many of them are profitable, which have you lost money on, and why, and what were the lessons learned. Those are going to be things that I think both buyers and the folks financing those purchases are going to really hone in on. So that would be, I think, probably my primary feedback. But then I think also, being able to continue to diversify your business and also be on top of working capital management. I think that's probably the other thing that we see is just how folks are managing their abilities relative to cost and be able to kind of manage the working capital in this business can can differentiate in terms of your ability to sustain leverage and think an attractive multiple.
Yeah, Jason, just one thing to add on that. It's a great point. One of the things that we always ask for that we'll do during diligence is we will do a review of, what did you budget on this project, and then what did you actually realize? It's one thing for a business owner to tell you, oh, I don't lose money on projects. That's great. But, let's look at the actual budget that, your estimating team delivered and what you actually realized on that project. Because at the end of the day, the underwriting is so much about that estimating team and making sure that they, are really dialed in on the cost, especially through, over the last 5 years. There's so many ways to get upside down, in construction, between material prices, between labor, that, you have a really good, track record over the last 5 years with all the volatility that we've seen. It's very impressive from the estimating department to, not lose money on jobs consistently over that duration.
And I think it goes back to your comments on kind of the governance and succession planning, because some of these businesses, if they're smaller, there is a degree of key man risk. Maybe some of that estimating or project approval is focused on one individual. And so in addition to the data kind of supporting how you performed over time, I think we really look for what are the risk controls. If a project over X needs to be approved by the COO, a project over Y needs to be approved by the CEO, those sorts of things. I think having those processes in place so that when you go to present yourself to the buyer community, to the lender community, you've got those kind of governance boxes checked is really critical in this space.
Excellent. Where do we go from here? So curious to hear your thoughts on the current macro environment. We heard a lot today, throughout the day, on macro, Texas related. What do you see in terms of moving forward in this space from here, from the acquisition standpoint? Are you looking to deploy more capital into the space, Brandon? Are you looking for roll-ups? Can you tell me a little bit about how you guys are thinking about the space moving forward?
Sure. Over the last 12 months, as much as we're equity investors at the end of the day, we like to talk about growth. We want to continue to grow our businesses and ultimately have a good exit. But focal point over the last 6 months in particular has also been downside and mitigating that downside. And there's been more discussions on let's make sure that we have diversified vendors for different cost categories. We've discussed in the past that once we sign a bid or contract on this job, that we're procuring all of the materials within that week. All right, let's make sure that we're actually doing that, because I don't want to be buying steel or aluminum 6 months later on this project that doesn't get started for 9 months. It's the simple fundamental business aspects that you kind of fall back to make sure that we're doing the right things given some of the challenging macroeconomic trends. But I'll say more generally, when tariffs first came into the fold, we all knew that there would be something coming. But once they were announced, there was a lot of small projects that people wanted to get a job done as quickly as possible for peace of mind. We don't know what this is going to be, but if I get this done now, I at least know what my costs are going to be. And so there was a nice inflow of smaller projects, but as we've seen with a lot of other companies, the capital allocation side on these larger projects has been challenging, where there's a lot of people sitting on the sidelines, waiting to actually break ground, on projects, which, depending on your labor pool and depending on how busy you are, that can end up being a blessing in a weird way, where we're already drinking out of a fire hose, and so pressing pause and pushing our backlog out a little bit has worked out great in some instances for a couple of our companies, but there's certainly others that you're really hoping that things get settled out quickly and projects start moving along.
Yeah, I would reiterate those points, and I think certainly as we think about the tariff exposure, I think we're very focused on exactly what you said. Our clients in the space, I think, have done a good job of locking in what they can at the time they bid a project, and kind of leaving really labor as being really the only kind of potential variable, and I think we continue to see that as important. Many of the folks that we have seen in either deals we've looked at or the ones that we actually have in our portfolio, a lot of them increasingly in this space have been tied to this build out of data centers. It's continuing. I think Comfort Systems is a big public company in this space. They've said they kind of don't see slowdown yet, but I think you've started to see a little bit of some questions as how long can that continue. I think that'll be something that we'll want to continue to watch. But we've continued this year to see more deals in the space. I expect we will continue to see some more going forward, and the ones that we've gotten involved with thus far have performed pretty well, so I think we continue to be favorable in the space.
So what's the end game? And this is probably more for you, Brayden. And as you look at the portfolio of companies you have today, can you share a little bit about your insights on plans in terms of growth and or again additional acquisitions? 5-10 years out, what are you aiming for?
Sure. I'll say one of the great benefits that Main Street has being a public fund is that we're not beholden to finite fund lives, having to return capital to LPs. So there's probably 15 of our 80 portfolio companies that have been in our portfolio for over 15 years. We have done the typical recapitalization transaction several times over in several companies where you had father and son dynamic, buy out dad, son gets backed by us, and then 10 years down the road he has this next layer of management and we can do the recapitalization again. So we don't have to have that exact exit dynamic that a lot of people are underwriting to, but at the same time it's a combination of let's be strategic and try to grow this in a reasonable manner. We don't want to be overly aggressive just for the sake of growth, but being strategic with M&A targets. For our company in West Texas in particular, we've talked about succession planning. I would say that what we underwrote from a succession planning standpoint might have taken a little bit longer than what we had hoped, and really making sure that the base platform business is really capable of doing an acquisition. The last thing you want to do is bolt on a company and then it's an orphan asset with it. It's never really integrated. So making sure you have the right base before really jump-starting the M&A machine is critical. Across our 80 portfolio companies, we have a president's conference every year where we bring in 80 of the CEOs, and we do an M&A panel every year. And the one consistent message that we always hear is that getting the deal done is easy, which we kind of laugh at because there's a lot of things that go on behind the scenes that they're not completely tied in with, but it's the integration part that's challenging. The cultural aspect, the people, actually, making sure that the synergies, exist. That's a challenging aspect of it, but making sure that you have a solid foundation is obviously critical before, starting that M&A train.
We oftentimes talk about in the deal world, people focus on the marriage and maybe not as much on the wedding. And that honeymoon is super critical for success to make sure we get it right. As more consolidation goes on, how do you see, or what's really important for smaller players to focus on to be competitive? As you've got roll-ups going on in your backyard, and we're seeing it here in our markets in Texas, what do you see as being important for the folks who are in the space today to be focused on so they can remain competitive?
That's a tough one. The thing that comes to mind for me would be having a niche, having maybe some specialization, whether it's from an industry and market perspective, that you can really own and own relationships in that space. I think that, and then you can be, perhaps when you do come to that point of wanting to maybe exit, then you're perhaps an accretive addition to somebody's platform because now they're buying a specific expertise. But other than that, the scale would be difficult.
I completely agree. I mean, the economy is the scale, working against some of this large competitor in the space. I mean, price usually wins, but as we've talked about today on transactions, sometimes it's relationship, it's fit, it's all the other things, not necessarily the headline number. So one, making sure that you have good case studies, making sure that you have good relationships with the EPC or architectural firms that you consistently repeat business from them. It's great, but carving out a niche where we are the best player at this in this market, then that's critical.
Excellent. Any lessons learned from your experiences with clients that you do want to share? Stories?
Not to get too far in the weeds, but we mentioned POC accounting. I would say one thing we've looked at, I would say at Main Street over the last 18 months, we've probably looked at 40 HVAC deals. There's a lot that are in market. We like the space. We've looked at a lot of them. I would say that probably at least 25% to a third of them all have some type of POC accounting issue. It seems very simple, but if anyone who works in construction knows anything about retainage, if you have a $10 million project and you have 10% retainage on that project and the project's a 20% margin type deal, okay, you're making $2 million on it, but half of that margin is getting tied up in retainage. So you work on a project for 12 months, all of a sudden it all gets released, as soon as you complete the project. Well, if you're not accounting for that properly, you're recognizing $1 million of profit over 18 months and then the lump sum of $1 million. Well, we have seen instances where deals have crashed and burned very quickly due to the fact that they had a couple $1 million of retainage that was all rolling off at once and they weren't accounting for it properly. So some of those simple things that can alleviate a massive headache during a process, or you get valuation expectations here, and then something like that is a little bit of a shock. Stuff like that is just critical to make sure everyone's on the same page going through the process.
Yeah, I would add to that. I mean, that's I think that's the area that can make the industry a little bit scary from a lender's perspective. As a lender, you want some degree of covenants to track performance of a business, and I think what we've seen in cases with percentage of completion accounting is everything can look okay from a financial reporting covenant perspective until it all of a sudden doesn't. Where most operating businesses, you tend to have a little bit more. You see it coming a little bit from the financial perspective, and you're going to catch it from a covenant perspective. So I think just being very, very in the weeds from an accounting perspective on project performance, and really I think working capital management, as I alluded to. I think what we've also seen is having companies make sure they're ahead of the game from a billings versus cost perspective. So if they do get into contract disputes, they're not also trying to recover a bunch of unbilled costs at that point in time, particularly if it's a contract that's bonded, where maybe their negotiating leverage with their counterparties can be a little bit more limited.
Yeah, Jason, we've outlined a number of kind of negative aspects, but I mean, the one great thing that construction companies, HVAC, has is that you do have backlog, which is great from a lender's perspective to underwrite too. So having good data around that backlog, showing how that's trended over time, showing the composition of it, showing the margin composition of it, how much of it's tied to one individual project versus everything else. Having good data there can be a great underwriting asset for you going through the process.
Yeah, you've got many companies say that they're going to have backlog stretching to 26, and so from a lender perspective, being able to underwrite that, it is a huge value add.
Thank you both. I'll just take a moment and open it up to the floor for questions.
Already a question. Break this down for me, guys. You guys are real smart, so I'm a simple guy. Break the segment of the marketplace down for me. Installers, servicers, evaluators, are all of those a part of your marketplace?
It depends. So our company in particular, they do the install, they do sheet metal fabrication, a lot of the air handling units or the larger, more technical aspects. What's going into your mechanical system is sourced from the trains of the world, or whoever's manufacturing those. But generally they're doing manufacturing and install on the job sites. You also have the residential side where that's basically just all install itself. The overall mix of it, I don't have a great sense of percentage wise.
It's dependent in our case. Like I said, a couple of ones we work with, they're like 50% install, maybe 30% rehab, replacement, the balance and service. And on the install, these are you're building a new building, you're doing your HVAC system, your plumbing system, and some of it is constructed on site. We've seen some folks as a way to grow and take margin, working on more kind of modular off-site manufacturing and then bringing that to the site as a way to reduce lead times, et cetera. So we've seen some of that as well, but it's really a mixed business by business, and some of them are going to be more exposed to just pure construction. Those are they're going to be a little bit more cyclical.
Do you see these companies that are now evaluating the work as important, and they come in and they have a service that they provide, that they test out and see, did that contractor do his job, And they certify it for whatever purpose, like in San Antonio, there's some regulations around that. Are they in your space?
I believe so.
Yeah, I think that's right. But I think there's some of the companies that we work with, and this may get your question. I mean, they've got a lot of repeat business. I mean, they may work with like a health system, university system, and they're constantly doing rehab refurbishment. So there's a little bit of an ongoing check of if you haven't done a good job, you're not going to go to the next contract. But I think anybody related to this space can potentially be a potential financing candidate for us, certainly we'll like some generalists.
Other questions? What's on the left here?
What are the,
To your left.
so I have two questions. In regard to the client mix you discussed and the customer mix, are you looking at that on a company by company basis, or do you try and get that mix across the entire portfolio? I guess, in terms of percentage of commercial versus residential, etc. And the second question, do you see any things that could be a negative for the seller where that's an opportunity for you as a growth opportunity post-close? So not so much distress, right, but what are some of those things that you're looking for that you can manage as a buyer?
Sure. And as far as looking at it across, multiple companies, for the platform investment, you certainly look at, all of the different, components of, the acquisitions that you've done on a consolidated basis. I would say the value that you could see is, for several of our companies, they work with XYZ EPC firm or architectural firm. They say, hey, we do not have a good contractor in this space, in this region. They find somebody that's maybe not in the best in markets. They're doing, high-rise, apartment buildings. Well, I'd much rather be in, a university system because they have committed capital via endowment funds, and that they're going to replace this dorm in 10 years, and this in 10 years, and this, where it's more consistent, not as volatile just with the general market of it's a good time for construction or not. All of a sudden, you can buy this asset. Yes, we know this piece of the business is risky, but we can supplement it with our relationship with this firm that really wants us to expand into this market. There's certain negatives to a deal that you can supplement, certainly if the right situation exists.
Yeah, I would say from our perspective, each deal's standing on its own. So we're evaluating each individual company in terms of their customer mix and market mix, et cetera. And then maybe to the second part of your question, I think to Braden's point, I think we've seen the ability to add maybe a complementary service to where you're more of a potential one-stop partner to some of these general contractors. I think has been attractive in certain instances. I think we've seen folks that maybe haven't had as big of a service component maybe go in afterwards and start to develop some sort of annual service contract approach with some of the folks that they're doing install work to try to have some degree of recurring revenue, and I think those have been some of the opportunities that folks have taken, in addition to the kind of off-site modular, I'm gonna build it here rather than building on the site. I think those are maybe been some of the post-close process improvements that we've seen play out.
Also, from a transaction standpoint, we always encourage our sellers to help think through and provide those growth opportunities, is to help paint that picture for a buyer. So part of the strategy before going to market is to outline, here's where we see opportunities in the marketplace. It also helps to identify who might be a good buyer. So if you've got local expertise, if you've developed a niche, and you understand, here's how I can leverage this capability into the market, whether it be into adjacencies or to different customer or client relationships, that's a helpful thought exercise to go through as a business owner, to understand if someone comes in, where are the levers that they can pull for growth, and then it becomes a really interesting conversation with the right buyer when they hit your doorstep to understand post-transaction, what can we prioritize and go after that's going to help us get to that next stage of growth in the company. Great question. Other questions?
In some installation services, the OEM relationship is really important. Is that true in HVAC?
It certainly is from an OEM perspective, there's certainly different tiers of OEMs. Obviously on our commercial side, we stick to one or two, and the relationship there is very critical. I'll say on the residential side, one unique aspect to HVAC is that if you've had one installed or replaced recently, they're going to push you for a warranty plan or a recurring maintenance plan that they come and check in every month or so. A lot of that's coming down from the OEMs basically saying, hey, your warranty will be voided if you don't sign up for this recurring maintenance plan because you're not taking care of this asset, and if it breaks, that's kind of on you. So there are some nice symbiotic relationships that the OEMs have tying the warranty to maintenance. That's obviously a massive benefit for all these install and service providers because it gives them a pipeline of recurring service work. So it is a very important relationship to maintain, to say the least.
Well said.
I think we have time for one more question. Any takers? Sir?
Since no gas, are you seeing a general slowdown in there's a lot of city building construction
Slow down where?
in the subcontract space due to construction?
Construction slowdown.
Yeah, right now, I would say, for our pool business, certainly has. So we all know that, that market was, very, very hot and is slowing down. I'll say in the HVAC space, it has been strong. It depends on the end market. So, our company's dealing with hospital systems, education, a lot of places that have committed capital and bonds that have been outstanding for a period of time. So you have nice visibility, during that period. There has been some slowdown just in the sense that let's press pause and try to have a little bit more comfort level of where the economy is and where tariffs are before taking on an 18, 24-month project. We've certainly seen that. But I mean, generally speaking, it has been fairly resilient, at least for us personally, in a one-off case. It's more of a question of, I think, really over the next 12 months, once that backlog evaporates, how are you replenishing this, time will tell.
I think we are at time. Brandon, Jason, thank you so much for joining us today.